Are you considering an SBA 7A loan to start, grow, or acquire a business? Let's discuss the pros and cons, starting with the two least attractive aspects of the loan. Hey, I'm Ray Drew, an actual SBA lender, and in this video, I'm going to share with you the good, the bad, and the ugly when it comes to SBA 7A financing. The SBA 7A loan is the Small Business Administration's flagship program. Small business owners can borrow up to $5 million for all sorts of uses, and they do, to the tune of $25 billion a year. So whether you want to buy a building for your business or acquire a business or expand, it's worth taking a look at this financing program. Now let's start with the cons. Con number one is the SBA's collateral requirements. The SBA requires you to pledge all available collateral when the business assets don't fully secure the loan, which is most of the time. So if you own real estate with equity, and that includes your primary residence, you're likely going to be required to pledge that equity toward the loan. So in other words, the lender is going to place a lien on your house. The exception being if you live in Texas because of a state law. Now you may be thinking to yourself, there's no way in hell I'm letting the bank put a lien on my house. Who would want that? Well, if it means getting the loan that you need to acquire your competitor or consolidate your debts and cut your monthly payment in half, you're going to have to. Now, while most people don't love the idea of pledging personal collateral for a business loan, the 7A is still a wildly popular program because of the benefits, which we're going to get into shortly. But first, let's talk about one more aspect of the 7A loan that most people don't love, and that is that the interest rate is usually variable. The most common rate adjusts quarterly and is tied to Wall Street Journal Prime. So if the Fed changes the interest rate, your rate moves along with it the following quarter and your payment readjusts. So those are the two parts of the 7A that most people have concern around. That said, virtually every other aspect of the 7A is superior than just about every other commercial loan product in its class. One of the biggest benefits of the 7A is the low equity injection requirements. For example, if you want to buy a building for your business, conventional lender is going to require 20% down, whereas I won't require any money down as a 7A lender. Now, some SBA lenders will want 10% down on real estate, but that's not an SBA requirement as long as the business has been in business for more than 2 years. In fact, the SBA only has set equity injection requirements for 3 things: startups, business acquisitions, and some partner buyouts. And that number is 10%. For everything else, they allowed the lender to analyze the balance sheet and determine, does the business have sufficient equity already invested in the business? And if not, they may require one, and it might be 5%, it might be 10%. It varies. But it's always going to be lower than what a conventional lender will require. And that means up to 100% financing for expansion, commercial real estate, debt refinance, equipment purchase, and some partner buyouts. The second huge benefit is the longer terms, which translates to a lower monthly payment. Let's face it, in small business, cash flow is king. What matters most is how much is in your bank account. And that's why having a more affordable monthly payment is such an attractive benefit. We're talking 25 years on commercial real estate versus usually 20 years with conventional, depending on the asset type. And also the SBA is a fully amortizing loan, whereas conventional loans are going to have a balloon after 3 or 5 or 7 years. And that's going to force you to refinance at that time, which means uncertainty, which is not good for business. Business acquisitions are financed over 10 years, which is compared to 5 or 7 in conventional, if you can even get one. Number 3 is the prepayment penalty, or lack thereof. There's no prepayment penalty on SBA 7A loans if the term is less than 15 years. Meaning you can pay off your entire loan early with no penalty. That does not exist anywhere else in the market. And if the term is 15 years or greater, the penalty is only 3 years. 5% in year 1, 3% in year 2, and 1% in year 3. And then it goes away. And the penalty only applies if you're paying more than 25% of the principal in any of those years. Just for a comparison, there's products with as much as a 10-year prepayment penalty. So having this type of flexibility is great. The lack of loan covenants is one of the most underrated benefits of the SBA loan. See, in conventional lending, banks can include covenants into your loan that can put you in default if, for example, your debt service coverage ratio drops below a certain amount this quarter, or the equity in your balance sheet drops. They can prohibit you from taking on new debt. Basically, they have control of your business, and I'm sure you didn't go into business so that your banker can tell you what to do. So I think you're gonna like the SBA product for that reason. You're still gonna need to provide your tax return and personal financial statement every year, but as long as you make your SBA payment every month, you should be fine. The last benefit might end up being your favorite, and that's the ability to include multiple uses inside of your loan, making the 7A a one-stop shop for all your needs. The flexibility of this program gives the lender the ability to truly customize a loan that perfectly fits your needs. This does not exist in the conventional world. Let me give you an example. You're growing and you want to buy a building that's double the size as what you've been leasing. A bank's going to finance the real estate no problem, but that's about it. What if your plan is to fill that new space with a couple new pieces of machinery, and you're gonna need more inventory to increase production, and who's gonna operate that machinery? You're gonna have to hire more people. Well, with the 7A loan, you can structure a loan to buy the building, purchase the equipment, buy the inventory, and get working capital to hire more employees without having to bring any cash to closing. Now that lien on your house isn't looking so bad, huh? There's one more point that I should mention, and that is that the SBA 7A program has looser underwriting guidelines than conventional lending. Looser on debt service coverage, you can even underwrite projections in some cases. SBA is more forgiving if you had credit issues in the past. SBA lenders will generally be open to all industries, whereas conventional lenders stay away from certain industries of higher risk, like restaurants, for example. Conventional lenders also require more years in business before they'll lend to you. For these reasons, a lot of SBA 7A borrowers don't even have an alternative financing option with reasonable terms. And that's really why the program was created in the first place, to ensure that small business owners had access to capital on reasonable terms. So let's recap this real quick. Here are the pros, and here are the cons. I hope this video helped. If you have any questions, drop them in the comments and I'll tackle them one by one. So there you have it. If you found that video helpful and you want more insider tips from an actual SBA lender, I would invite you to click that subscribe button because I've got plenty more where that came from.